I'd like the panelists to talk a little bit about themselves, what they do within their individual companies, and then we'll get into the questions. And if you have any additional questions to ask, if you just hold it till the end of the discussion, we'll open the floor to questions moving forward. Okay, so let's start with Jason Berenstein from District Ventures. On the end, Jason, can you tell us a little bit about District Ventures?
Sure. Thanks,
what
Michael.
you do?
So District Ventures Group operates right now 2 accelerator programs. One is a business accelerator in Calgary that is a 5-month program that brings in early stage companies, invests in them in the food, beverage, health, and wellness categories, and puts them through a learning process with mentors and formal programming. We also now operate what was the Food Starter program here in Toronto at Keele and Lawrence, District Ventures Kitchen, and that is 20,000 square feet of commercial kitchen space for companies looking for either innovation resources, a place to manufacture at low volume or small volumes as they're getting scaled up. And then finally, there's District Ventures Capital, which is a formal venture capital firm that was raised about 2 years ago. And our mandate is to invest in food, beverage, health, and wellness companies that are in the CPG consumer goods space. And I'm a partner in the firm. I oversee the 2 accelerator programs. I also look to source and work on transactions and then support them post-closing. The firm is a little bit unique in the venture capital landscape simply because we actually have more marketing staff at District than we do actually have finance people. When we end up closing a transaction, we get very involved in helping companies with their marketing needs. So whether it's packaging, brand strategy, developing their brand roadmap, or their marketing plan for the year, we get heavily involved in doing that. We have expertise on staff in that regard. Over the last 2 years, we've invested in 10 or maybe 11 companies in the fund, and we've got another 10 or 11 companies that have come on in the accelerator programs.
That's great. The second panelist in the middle is Carolyn Miron, who is with Agropur. So Carolyn, if you can fill us in on what you do and what the accelerator program is all about.
Great. So thanks for the invitation, Michael. First of all, I'll just talk a second about Agropur because I'm not sure how many of you are familiar with us, even though you might know our brands. So Agropur is the largest dairy cooperative in Canada. We're about $7 billion turnover. We have 39 plants and we're present in all dairy categories. So from milk to ice cream, cheese, cream, whatever you have in mind. We're mainly, 50% of our business is B2B, 50% of our business, the other 50% is B2C. And we're present in Canada and in the US. In Canada with brands such as Natrel, Quebon, many brands that you probably would know about. And in the US, we're really focused B2B. So Agropur is 80-year-old cooperative. It's owned by dairy farmers. It's 8,000 employees, so a very big, I would say, company that wanted to innovate, that wanted to reinvent dairy. So I'm in charge of open innovation, and at Agropur, and our mandate is really to reinvent dairy together with, I would say, the rest of the world, or very concretely, we have 2 programs that we have put together. One of them is an accelerator program as well. It's called InnoAccel. It's focused on dairy products. Could be also packaging that can reinvent dairy. It's not only packaged good itself. It could also be a technology that can help us connect closer to consumers, but we're really focused to the, I would say, the last end, really coming closer to consumers. So that's InnoAccel, our accelerator program. We have a booth to give you more details in the show here. We're about to run our second cohort, and I'll give you more detail about that. And the other leg that we have to work with the, I would say, outside world or with the food ecosystem is InnoCapital. It's a co-investment fund of $40 million that we have in partnership with la Caisse de dépôt et de placement du Québec. where we look for later stage companies so $5 million revenue and up to invest in them. I would say only. It's not an accelerator program. It's really a co-investment fund. So that are our two main programs, and I'll talk later about that.
Fantastic. And our third panelist is Shayn Diamond, who's with Whitecap Ventures. And Shayn, if you can give us a little bit of background.
Of course. Thanks, Michael, for having me. So Whitecap Venture Partners is in its fourth fund. We've been investing in Canada and northeastern United States since the late 80s. Our fourth fund was raised in July of last year, a $130 million Series A venture fund with three different focuses. The first being software, second being medical technology and medical devices, which are pretty irrelevant for this conference, and the third being food and food technology. And within our food focus, we look at two different things. We look, much like my co-panelists, at CPG companies, but we also look at the implementation of technology in and around the food space, whether it be on the packaging side, whether it be a software implementation through, we were just talking about an example of farm-to-table blockchain. We get very deep in all aspects of food and aren't limited only to CPGs. Our mandate is to invest $2 to $7 million on an initial check with a view of being in each company for $10 to $15 million.
Great. So we're going to go through a series of only 4 questions so that we have time afterwards for your questions and answers. So the first question I have, and we'll go from Shayn down the line, is what sort of businesses does your company look to invest in? And what do you look for in those businesses?
I jumped the gun on my introduction, I guess. So if we split up our bucket of food and food technology, on the technology side, we're looking for software companies with roughly $1 to $2 million of revenue and software that can be implemented in food. On the food side, we're looking at very early stage companies. Our low bar is set at roughly $500,000 of revenue. But as we were talking about prior, when we were preparing for this panel, it's not always black and white, and there's a large gray zone. And so saying we're focused only on companies with $500,000 of revenue wouldn't be completely fair. There's a lot that goes into the, what we call internally the chili pot of an investment that we have to sort of unpack, and that can be anything from team, product, distribution, margins, scalability, market size, which I think we're all going to get into later. But at a very high level, $500,000 of revenue in the CPG bucket for us to get interested and excited.
Carol?
So we're a dairy cooperative, right? So we look for dairy products, I would say only. We're not into non-dairy or other type of food. So that's what the main focus we're looking for. It's open worldwide, but mainly North American is our focus. Even though we're Canada-based, we work with a lot of American company, and I would say English Canada, even though we're based in Quebec. Our accelerator is based in Quebec, And we're looking for companies that are actually in business. So we're not an incubator, we are an accelerator. So if you're a startup, you have to have some traction. We're still at a quite, I would say, large range because there's a lot of gray zone, as you said. We're looking below $5 million revenue, and that's very different if you do $50,000 or $5 million. We're trying to make cohorts that make sense, also in terms of size of the company, of stage of growth, and we look at packaging that could reinvent the industry, as well as technology, but really closer to consumers, not in the manufacturing side.
Okay, and Jason?
As I said earlier, we're focused on food, beverage, health, and wellness companies, primarily looking in Canada, but also in the U.S. The companies in terms of size that we typically get involved with, they're sort of in two buckets. They're either $1 million in revenue or higher, in which case we are engaging one-on-one to try to come up with a transaction structure, valuation, and a way to move forward that makes sense for both of us. Or if they're under $1 million in revenue, we're typically looking at the accelerator program that we operate out of Calgary. And it just makes a lot more sense for those types of businesses to go through that. And we've had a lot of success with companies who have come out of that program. And often what happens, and we can get into this a little later, companies that graduate from the program then come and get more investment from the fund as they continue to grow. So we are looking to invest and continue to invest in companies as they do grow. As Shayn mentioned, we do look at a number of factors before getting involved. One is, how big is the market that the company is selling into? What's the potential for it? The entrepreneur, him or herself, what is their sort of passion level, experience level, what have they been able to accomplish at the point where we've met them, and then the financial opportunity. Is the market growing? I mean, even if the market isn't as large as some, if the market is growing at an above average rate, it's interesting to us. And today, there are a lot of markets like that as consumers begin to shift their tastes from traditional brands and ways of consuming to new innovative ways of feeding themselves.
That's great. So that leads me right into the next question, and I'll start with Jason. You can carry on. What sort of trends are you seeing in the industry, and what sort of companies and products are you most interested in pursuing?
Sure. By now, we've all been reading about the trends in the industry, and some of them have, I would distinguish between a trend and a fad. And some of the stronger trends, that we even read about quite regularly right now, and we're seeing plant-based products get commercialized. Probiotics are making their way into foods that. Food and beverage, whereas, 2 or 3 years ago, we would find it either in pills primarily or in yogurts and other dairy products. We're seeing people eating for health. They're functional eating. And so a lot of the products and companies that do come across come to us, they're heavily they're trying to target something for the people who are ingesting them. So it's either protein or alternative ways of ingesting protein, probiotics, other plant-based alternatives. People are the whole kombucha and beverages, for gut health. There's just a lot of different trends in that regard. But the underlying theme is people eating for health versus just sustaining themselves through the day. That's primarily what we see. Food traceability, clean ingredient decks, and presenting a product to companies or to consumers rather, that are where you flip the box over and read the label. It's very easy to discern what you're putting into your body. That's a very strong trend that we're seeing, and also a direct relationship between the companies and their consumers. So over more than a few years now, social media has become very prevalent. It's very easy to get the word out as to what your product can do, and so companies are marketing much easier, much less expensively these days over those channels.
Great. Carolyn, what have you seen in the dairy industry?
So all the things that you're saying, I think, are true. One obsession we have, and I think that consumers have mainly, is sugar reduction or sugar avoidance. So sugar is enemy. Fat is back. Also, fat is good. Fat is back. That's a change. And the other evil is packaging. And not only plastic, any packaging. So one of the startups we had in the last cohort was called Salty Sweet, and they were removing the stick in the ice cream, for example. So the more you can remove packaging, the more interesting is for us. Also getting closer to consumers. All the online, when you want to go online and you're a dairy product, and if it's fresh or frozen product, it's even harder. That's very interesting for us to that's a strong trend. And also local, and I would say imperfection. I don't know how you call it, but I'm a marketer to start as a background. And when I was giving R&D briefs 10 years ago, launched Activia for in my early days of my career, it had to be perfect. It had to be the same pink. We had color Pantones and the texture had to be the same and all that. And now when we give brief to R&D, because that's also some things I do, is it has to be imperfect. And now they have no more hair because they go crazy. But something that is close to handmade, much more. Consumers want to know what they eat, and they would love to know that they could do it themselves as well. So that's something. It's a big trend we're looking at.
Shayn?
On the
You're
on the market side, one of the largest trends we're focusing on is aging millennials and their keenness to spend more on fewer items. And so on average, their basket size has been increasing in dollars while decreasing in item count. And so what we focused very heavily on is finding those niche products that on one-offs are actually more expensive than the competition, but are finding their ways into millennial buckets. So that's our sort of market trend. What really excites us about the space is the ability to complement bricks and mortar retail with e-commerce sales. And so we're looking heavily into companies, CPG companies, that can complement what I'll politely call the slogs of retail with selling online. We think that opening up the ability to sell, depending on what your food product is, obviously you can't ship a shelf-stable or a non-shelf-stable yogurt further than, it's a lot harder, or an ice cream, et cetera. But there is a huge market out there that the internet is opening, and it's enabling people to find to gain access to a different customer base through a different methodology of marketing and at a different price point, because you're not selling through a channel or a distributor. It's a direct sale. Of course, I caveat that with it all depends on what your product is, but the ability to do so has created a whole new world for people in the CPG space.
Okay. None of you mentioned food service or home meal replacement. Is that something that you see as a growing trend, and are there products that you are looking to invest in those fields?
Sure. Food service is an area that many of the companies that we look at either started. So, for example, we have a company that went through the accelerator and then came to the fund proper that makes barbecue sauce and salad dressing with Canadian ingredients, low on the sugar, low on the glycemic scale, and no MSG, so it's got some healthier attributes to it, but got its start selling to restaurants, selling to getting their brand on the menu at times, and then transitioned to grocery. Another company in our portfolio that makes chickpea and lentil pasta, primarily for retail. Because of the high nutrients in their pasta, there's a lot of interest from school boards. There's a lot of interest from the senior living homes, and generally, rather than going through the restaurant channels, they are finding their ways into institutional or commercial sales. So it doesn't generally start out as the focus of where we're looking to grow the businesses, but is definitely an area where many of these companies can gain some sales traction.
So let's carry on with that example. I was going to ask you, and I'll ask Carolyn, can you give an example of a company, no names have to be given, that you have invested in from a food and beverage sector point of view?
So we have a lot of activity in the ice cream business or frozen business. I can't give any names right now because there's going to be some announcement. So it's as boring as that, but and we look at all sectors, but that's one that will be announced quite quickly. And one thing I wanted to come back on what you're saying, or in food service, is even though it's harder and harder to develop the right products for many reasons, but one of them is that naturality is not now a hygiene factor, right? It has to be natural. It has to be an ingredient list that you can read. You have to know all the ingredients and all that. But at the same time, convenience is also super important. And it sometimes or often goes opposite direction. So we're products that could be sold in a retail, but also online. And then in food and service, it's also very, very interesting when you can diversify your channels like that.
Shayn?
Take the second half of your question,
Okay.
which was in and around meal kits, I believe. When I referenced at the very beginning the chili pot of things that we look at, we've actually shied away from meal kits, home delivery, mainly because one of the top things we look at, as Jason mentioned, is market size. What falls out of market size is competition, and what falls out of competition is what's your wedge and what's your unique attribute or benefit to the space. And if you're $1 cheaper and it's a race to the bottom, that's not something that interests us. We just made an investment in a raw, vegan, organic salad dressing, dips, breads, condiment company. We looked at them and we said, there is nobody out on the market that's doing something with this many SKUs in this space, back to the thesis of targeting millennials at $1 higher per product. And we made that investment as a result. Whereas on the flip side, the meal kits, we've met a lot of great companies. I'm sure everybody in here is familiar with one. And I think a lot of them have great products, but the differentiation ends up coming down to price. And, sure, maybe that piece of salmon is a little bit better than your competition, but what's going to end up happening at the end of the day is it's a race on price. And that's not something that we're interested in getting involved in.
Okay, good. So the topic of the discussion for this panel was part of it was cash flow. And in the years that I've been in the current position that I'm in, I've watched lots of companies who have grown to a certain extent through a farmer's market, local health food stores or natural food stores or specialty shops. And then they reach a certain point where a medium-sized chain is interested in their products. And they need to purchase that first piece of equipment to start to ramp up their production. And that's where they find difficulty because they haven't built up their revenue stream enough to attract regular financial institution to invest in. And yet they need that influx of cash to buy more equipment, buy more ingredients, maybe change their packaging, some of their marketing, etc. So my question to you is, can you give me examples of issues that have arisen in interviewing a client that perhaps they weren't forthright in telling you all of what their business was about, what their financial situation was like, and what it was that you how you dealt with it. So if a company is telling you that they've got the potential to do X number of dollars because of a business lead, how do you interview a business basically, and what is it that you are looking for from that company to give you an indication of whether you should invest in them or not? Go ahead, Jason.
There's a lot to that question, and we could talk about that for hours. I mean, during the due diligence period, after we've initially become interested in a company, we look at all those things, and it's sometimes very difficult to look at those things in too much detail, because oftentimes the company's only really been operating for 6 months, 2 years, and there was one instance where it was even shorter than that. But again, back to a comment I made earlier, what's the market size? Is the entrepreneur, quote unquote, backable? And is this something we at District can see ourselves adding value to, whether it's in the marketing, packaging, or advice giving that we can do? It may not be that the entrepreneur hid something or didn't disclose something. It just might be that they just haven't encountered the difficulties of not just getting onto shelf, either directly or through a broker, distributors that they have to deal with, listing fees, how to stock up on inventory. There's a lot of costs involved and a lot of obstacles to overcome to do that. And then once they do get on shelf, actually getting your product to turn 3 to 10 times a week per SKU is very challenging and a new sort of problem that they face. So it's not that they don't disclose it so much; it's that they just haven't yet experienced what that's like. And because a district focuses on food and beverage, not that we have all the answers, but we can certainly help work through that with them. In terms of the things that they don't disclose, which would typically end a conversation about transacting, is financials. I mean, if they don't have their financials in order, if they're not record keeping or have a respect for that, that's where things tend to break down.
Okay, good. Caroline?
You've said a lot. No, it's fine. It's fine. I'm just trying to add something to this because it's basically all you've said. And it's true that when at early stage companies, it's not that rare that finance are not in order. So that's an advice I would give to entrepreneurs, and we try to give very early to have your finance in order, because that cannot be the last thing you do, because when you're an entrepreneur, you miss time for your life, basically. You have no time, but you need to keep that in order, because if not, we're scared to invest in what's like the kind of warrants that we're going to open. So that's something very, very important. And to be very transparent. We are super open, we're super transparent, we're looking for the same, and we don't want any bad surprise when we start due diligence, right? So don't try, my advice to the people that are startups in the room or entrepreneurs, be as transparent as you are. Business is business, everybody. It has to be a win-win, I would say, deal. Nobody wants to lose, neither the entrepreneur or the company, and we all, I think, are doing this in a right mindset. Nobody wants to steal anybody. I think I haven't seen that a lot. I don't know about you guys. So be as transparent as you are. Again, it has to be win-win. So you need to think about your financials and be solid on that side, and think about how because even I would say the old model was you need to ramp up and do millions of SKUs. I'm not sure that's the future either. So you need to think about new ways of making businesses, because consumers want small brands. Consumer wants handmade, I would say, bracketed, but they're ready to pay more for that. So probably the best path is not to buy a machine to do 1 million units. It might be different things. So think about new ways of businesses, and always think about having good margins, because nobody wants, or I don't know anybody that wants to invest in companies that have the race to the bottom. We are all saying it, and even with their internal innovation, when you launch a new product, it needs to bring more value, because if not, you have other ranges of products. Big companies have other ranges of product for the race for price. So always think about that. Finance is such a big piece of your company, and we're there to support with marketing, with a lot of things. But the finance you need to have in order and to master.
And so, Shayn, just before you give your answer, Jason mentioned about knowing the market and understanding the growth and what your unique selling proposition is. Is that something that's important when you talk to a new company?
I was going to take a little bit of a different approach because they took all of the answers. What I was going to say is, there's a flip side of the relationship where, coming from a venture perspective, and you guys each have a little bit of different practices than we have, but there's also a large onus on us as a venture fund to understand the businesses that we're meeting, and understand that a dairy company is different than a salad dressing company, which is different than a meal delivery company, and understand that market. But on the flip side of that, and we try to be very transparent in our conversations, like Caroline was saying, venture capital isn't right for all companies, and not all companies are venture capital financeable. And so I know this isn't exactly the question Michael asked, but something that I think is really important is the internet has been an amazing tool for software companies and news and dissemination of news, but it's also really glamorized taking outside capital. And I'm not slandering my own industry, but not every company is the right partner for a venture fund, and not every venture fund is the right partner for a startup. And so what I would encourage is to not just look to venture capital because you think it's the right thing to do, but also look at other opportunities. Just because you're a company that can grow to $2 or $3 million a year of revenue, be profitable, and doesn't mean you're a bad company. When we invest in venture fundable companies, we're going to have a target of putting in $5 to $10 million and 5 to 10xing our money, which with the current multiples in CPG means you need to grow a pretty substantial company in terms of revenue and EBITDA. Not every company is going to be able to do it, but that doesn't mean that your company isn't a success because you can't raise venture financing.
Great answer. So now's the time to open the floor. If there's any questions for any of the panelists. Anybody? Some of you might be looking for dollars. If you got a question that you see hasn't been answered yet. So the question is, how long a process does this usually take once a company approaches you? I'm assuming it's different. Venture capitalists probably takes a much longer time.
From our perspective, we understand that when you're starting a company, your most valuable asset is your time, and so we try not to waste it. So within 30 days, we try to go to term sheet, and within 60 days from term sheet, we go to close. Our goal is to do enough diligence in the first 30 days that something very nefarious would have to jump up in the 60 days of diligence to not do the deal. So I'd say 3 months beginning to end.
Jason?
It can extend depending on the responsiveness of the fund, depending on what's happening within our business at the time. And it also depends on the responsiveness of the investor, the entrepreneur. As we talked about, the financial records and their availability, and what information they actually do have to provide us to complete our work.
So if a company approaches District Ventures Accelerator, how long would it take for a decision to be made whether to accept that company into the program or not?
Those decisions are actually made relatively quickly. We do there's an online application to get access to the accelerator. We look at the applications twice a year. We onboard companies twice a year, and it really comes down to profile. We have a meeting. We do look at some financial records. It's not as in depth of a review process as a larger investment from the fund. So that could be all said and done. Typically, the legals take a lot longer in those scenarios because these companies are smaller and they don't typically take a lot of time to go through a lot of the detail. It's really the entrepreneur's first time selling equity in their business, and that they do as much diligence on us in that regard as we're doing on them.
Okay. Got a couple more questions. One here. Go ahead. So the question was, how do you deal with a company that approaches you that you already have a business already similar to that in your accelerator or program?
Our approach is transparency. We'll sit down and say, we have a company. It's all of our companies are listed on our website, but if somebody approaches us, whether it's in our software, our medical, or our food, if there's anything that we think may be conflicting or competitive, transparency is the way to go. But I would also encourage a startup to not open the kimono until you have an NDA signed. Your first information package should be such that it's high level enough to grab somebody's attention, but not deep enough that you're sharing any IP that could potentially infringe on the success of your business.
Carolyn?
We also are all about transparency, but we try to have not direct competitors. Not in the accelerator. I would not choose two companies that are direct competitors because just for the sake of the cohort and we don't make a lot of deals. We're more a manufacturer, right? We have this leg of our company, but we don't make so many deals, so they wouldn't be beneficial for us to have two competitors, very close competitors.
Similar within a cohort in the accelerator, we will not put two companies in that are competing with each other. It would really disrupt. One of the things the companies really like about going into the accelerator program is their ability to work with the other companies, share experiences. So if you have two competitors at the same time, then that's problematic. That said, from cohort to cohort, we wouldn't restrict competitors. Now, at the fund level, we're investing a lot more money, and there's a tighter relationship. We would would be very careful not to invest in two competitors, only because how do you then make objective decisions and not let it's only human nature if one has found a co-packer that's working great at a lower price, you're gonna want to tell the other company in your fund to go do the same thing, and it's just you'd have to fight every urge, so we would avoid that.
Okay. I want to thank the panelists for participating this morning. I think they've covered a lot of territory for you. One of the things I would add on to what was already said, and some of the experiences that I've incurred over the number of years in the incubation stage, is sometimes it's really important for you to talk to similar companies, not maybe the same, but similar companies. They tend to want to share information which is valuable when you're growing your business. Understanding who the suppliers are, who retailers are that you shouldn't necessarily be doing business with at a stage in the company. Those are all valuable information. It's not always the best solution to keep everything secret and to yourself, because sharing information helps to grow your business in the long run. Okay, thank you. Thank the panelists, please.